Good morning and welcome to a new week of Join the Dots. Now this is being recorded on Monday morning, so I've seen Asia open, but I haven't seen Europe yet. And I haven't seen, obviously, America. So silver and gold slightly down, so Asia didn't come in and buy it after Friday's 2-3% sell-off. I'm not too worried. As I say, it's a journey. If you understand the journey principle, does it matter if it falls 2 or 3%? No, it doesn't matter at all. They may try and push it further. They may. Obviously, the banks are well out of their depth in terms of this market, having had 50 years of just making money out of abusing the public, like many companies do and have done. Corporate fascism, see it everywhere. Now the bullion banks are on the wrong end of a hiding, and the public are, I think, if they go for the journey, they'll deliver that hiding to the banks, which they thoroughly deserve. But we'll come on to banks in a minute, because banks is the issue of today's episode. First of all, though, we start with queues for gold and silver in Vietnam. I've got another video in from Australia this morning. The queue outside ABC Bullion in the Sydney Central Bank District is actually worse today, and they've got building marshals out trying to move the crowd because they're blocking the pavements. So someone put on my site, it was a promotional video from ABC Bullion. No, it wasn't. It was just the truth. If you don't like the truth, you won't see it. Sadhguru. We'll keep coming back to that because it is so endemic in today's world that people cannot see something they don't like. And yet that's going to cost them billions. Billions. Here we go. So what have we got? Head of the IMF in the Guardian newspaper, so you can find it if you want, says private credit risks keep her awake at night. Again, banking issue, we'll come back to it. And obviously investor issue. I've got the first link, is called Silver is Out of Balance, and it's a nice little short. It's Mike Maloney. So it's from a site that has a following of 857,000, so it's pretty credible. Okay. What else have we got? China house prices drop faster. Well, that's obvious because we've got 30 million empty units and no one's got any money and jobs are going. And they know now that they're over capacity in absolutely everything, so more jobs have got to go. They're in a mess. Let's see if the shill's come out. What's it, living the dream? What a shill. Have you seen his comments? Honestly, so ignorant. Don't listen. They can only say one thing. They're shills. CCP shills. Okay. So China home prices drop faster. That's for you living in the dream. Enjoy. All right. Oil. Now, oil is going to be an issue later this week. We're going to come and do some oil specials because oil is going into super contango. And that means it's in a real mess. That is Donald Trump's aim. You like him or hate him, I don't care. Get your personal feelings out the way of your investment decisions. Okay, get your personal feelings, get your politics, park them at the door, get rid of them. Listen to what is coming. Okay, because Trump would very much like a lower oil price. Who would it hurt? Russia, Iran, Venezuela, the Gulf states. He's not so anti the Gulf states, but it will hurt them. And I've got a piece here, haven't I, from a friend who sent it through. That's really, I've said it anyway, so you've got that. Francis Hunt, I see he's got a piece out on the gold-silver site, and it says gold-silver ratio at 9.99. I think that's for effect. I think it's 10. We'll call it 10, shall we? So if that was right, today's gold price, even if gold stayed where it is at 4,002, silver would be 420. And as I keep saying to you, as I do these videos, in a crisis, the ratio will narrow considerably. My view, I think 15 times. Manarino's view, 15 times. Francis Hunt's here says 10 times. Fine. 10 to 15 times, I'll go with that. So when gold's 8,000, silver will be 800. If we're in that sort of crisis. That's the journey. That's the journey we're on. Okay, now, the second link I'm going to give you, let me just activate my phone. The second link I'm going to give you is from another one we've seen before, Neil McAvoy Ward. Now, Neil has 535,000 subscribers, so not a lone voice. and he sees the banks in trouble. More bank collapses on the way. We're just going to come on to that with Greg Manarino's piece. That's link 2. Link 3, world affairs. US banking crisis incoming. World Affairs have 539,000 subscribers. These are not lone voices. These are not people out on the left or out on the right. These are central voices with massive number of followers, subscribers on YouTube. So that's 3 links today. I can't link Greg's pieces, but I'm now going to talk you through them. Okay? I can't link them. You know what it is? It's $3 a month or $30 a year. Goodness me, it's so cheap. He put up 5 trading tips last week. They all made money. Traders, if you are a trader, remember I don't agree with trading on principle, but if you are a trader, that's fine. It's a free world. Then, well, some parts of it. Then you can trade. And you've got to pay $3 a month for that privilege. Oh, goodness me. Okay. So here's Greg Manarino's piece, 17th of October, part 1. I'll do part 2 tomorrow. Part 1. Regional banks are breaking again. Back in 23, Greg called it prior to the collapse of Silicon Valley, Signature and First Republic Bank. But at that time he said, it's not over. And I said the same to my clients. It's not over. Okay, it's gone quiet. They've resolved those 3, but it's not over. Those were mainly bond crises. Those banks had loaded up on government bonds and got caught by the interest rate rises, and they just couldn't sustain their balance sheet. So they had to come. They had to come open, and they got taken over, and the government bailed them out, mainly because they were hugely Democrat banks. They were in California and New York, and it was the rich elite who were going to lose money. So the Democrat government at the time bailed them out. Think of it, California, New York. It's their heartland. Okay, and big banks, says Greg, they are carrying massive, and I mean massive, unrealised losses and extreme liquidity risk. And as I said to you before, banks can carry losses. They can avoid marking them to market. They can let the bonds run to maturity. But if they run out of liquidity, a bank is finished. Like in 2008. Remember? Northern Rock went in the UK in, I think, October 7. Bear Stearns went in March 8. Lehman went in September 8. Okay? When they run out of liquidity, there ain't no shelter for them. Shadow banking. Shadow banking equals banking without banks. I love Greg. He's so blunt. Okay? The world comes up with the term shadow banking. It means banking without banks. That's what it means. Not shadow anything. There's no banks. Shadow banking is a web of funds and dealers, money market funds, repo markets, hedge funds, private credit funds that take cash in and lend, invest it outside of the FDIC deposit regulations. How it works. Cash parked in shadow banking funds is lent overnight in the repo market. Loans backed by treasuries. The shadow banks, money market funds, repo market, hedge funds, private credit funds, take that cash lent overnight in the repo market and leverage it against their collateral. And what we're going to find out is they've leveraged it how many times against the collateral? The same collateral, rather like First Brands, 3, 4, 5, 6 times. No one checks. Too busy making money. No problem. That leveraged cash is then used to buy more securities, finance trades, or make new loans at extreme leverage without checking the collateral. Fake liquidity. This back and forth movement of cash via repos makes markets look flush with cash, but it's not real. It tricks the system into seeming more liquid than it really is. And seeming is not real, is it? If something seems real, it's not real. Okay? Now this is where it starts to get interesting. Using this mechanism, the shadow banks are able to make loans against their collateral at up to, are you ready? 30 times leverage. You read that correctly. 30 times. This mechanism only works because the whole chain depends on rolling short-term funding every day. But what happens when that short-term funding dries up? Liquidity, liquidity, liquidity. Exodus pyramid, derivatives, quadrillions of them suddenly go from base of a pyramid to the tip. There ain't no place for them. There ain't no liquidity. There ain't no place. They die. These extremely leveraged phantom loans will get cooled and the entire shadow banking system will collapse. Now remember, banks work on a sort of a principle of confidence. Once one bank says to another bank, oh, I'm not really sure about you. This happened in Dubai 08. Okay, the international banks started to think, Dubai is a little bit risky, we don't lend there, stop lending. That took out the liquidity of the system, property prices fell, system got worse, blah, blah, blah. This is what's coming, just telling you, this is the journey, okay? So, the key point here, the shadow banks is the glue running the credit pipes of the system. And it works right up until loans get cool. Now remember, all these banks, JP Morgan, Jamie Dimon, Bank of America, is it Moynihan? They're all sitting there now in boardrooms looking at each other saying, do we get out first? Because it's only the person who gets out first that gets out. This is like a fire in a theatre, okay? Bank runs are like a fire in a theatre. First out's the only out. Everyone else is caught. Everyone else is trapped. Everyone else is clambering over each other trying to get out. And they can't because there's no room at the exit. The exit's blocked. And in banks, there's no liquidity. So he says the fake liquidity simply isn't there and the entire system locks up. What's flashing yellow now? Shadow banking funds are deep in loans which will, and already are, starting to default. 2 banks went last week, remember. Zions and another one. Okay, unrealised losses are now becoming real losses, and they have to sort of respect them and they have to admit to them. Why it matters? The shadow banking system exists because it provides the mechanism where system credit lives. Moreover, shadow banking credit lives outside of the FDIC. They don't even know what's going on, the FDIC, the Fed. They don't know what's going on. And they're not insured. The FDIC is the insurance corporation, isn't it? That insures people who have their money in funds in banks. These are not FDIC insured. People, and so what will happen when people start to sense this is happening, they'll want their money out of these non-FDIC banks because they're not guaranteed, they're not insured, they're not covered by the government. Can you see it? Liquidity will just suddenly gush, or rather disappear. It won't gush, it will gush, but it will gush out, not in. Okay, this will eventually lead to extreme forced selling of collateral, which has been leveraged 30 times. And this is what we find with First Brands, isn't it? And Jeffries and Blue, whatever it's called. We're finding now that when people challenge the collateral that they say they've got, they haven't got it. And it's been pledged 3, 4, 5, 6, 10 times to different lenders. Can you see it? First out, only out. Everyone else stuck. Okay, so a complete systemic meltdown will be the result, starting in the credit debt markets, which will cause a collapse in the world stock markets. Now this is what Euro Dollar University says. Look at the debt market. The debt market will tell you where the equity markets are going to go. And when the debt market struggles, equity markets tank. And all that leverage, all that corporate, all that exposure, all the margin trading collapses in on itself. Okay, so that's part 1 of Greg's piece. And it just rhymes, doesn't it? It rhymes with Neil McAvoy Ward. It rhymes with World Affairs. It rhymes with everything I've told you about where we are and Exeter's inverted pyramid. Everything that seems safe at the moment will appear very unsafe, very, very high risk. And everything which for years has been perceived as high risk, which is ridiculous, isn't it? Because gold is not high risk. Gold has performed better than the S&P, the Nasdaq, and all of them for the last 25 years. And it was still at the top of the pyramid. Well, no, the pyramid's turned. Gold is now at the bottom. Silver's going to be at the bottom. So we might have a few days of traders trying to take the silver and gold prices down a bit. Or the bullion banks trying to get some money back, which they've lost. Lots of it. But it's a journey. And the journey is a safe one. Back tomorrow. I'll read the second part of this out. Okay? He's brilliant, Manarino. Well, whether you like him or hate him, I don't care. Again, go back to Sadhguru's comment. Okay? If you can't see what you don't like, you won't see the truth when the truth isn't nice. This is truth. Thank you very much.